NIO shares are showing signs of recovery today despite reporting declining revenue and a wider net loss for the third quarter. The electric vehicle EV manufacturer faces mounting pressure in the highly competitive global EV market, with the need to reduce prices weighing on its financial performance. Meanwhile, in the United States, the EV sector faces a new challenge as President-elect Donald Trump has vowed to eliminate a crucial tax credit that has been instrumental in driving the nation's transition to clean energy vehicles. This development introduces uncertainty for automakers and could significantly impact EV demand. Here with a deeper analysis is Ecovegeta. Thanks, Brad. The tax credit in question is a key component of the Inflation Reduction Act era. It provides U.S. consumers with a $7,500 credit for purchasing a new electric vehicle or plug-in hybrid, $4,000 for buying a used clean vehicle, and additional credits for leasing EV. Trump's campaign promise to cancel these incentives could dramatically alter the landscape of EV adoption in the U.S. According to a report from Bloomberg, revoking the tax credits could reduce future EV demand by as much as 27%. Research conducted by UC Berkeley highlights the potential consequences of such a move. The study estimates that annual EV registrations in the U.S. could decline by 317,000 vehicles, a considerable figure when compared to the 1.4 million new electric cars registered in 2023, according to data from the International Energy Agency (IEA). This drop in demand would ripple through the industry, with automakers most reliant on the U.S. market feeling the greatest impact. Piper Sandler analysts specifically point to Tesla as a company that could face notable challenges if the tax credits are repealed. Tesla generates approximately one-third of its total vehicle deliveries from the U.S. market, and the firm estimates the removal of tax incentives could lead to a 20% decline in Tesla's domestic sales. The impact on Rivian, another EV maker heavily focused on the U.S., could be even more pronounced. Rivian derives 90% of its revenue from the U.S. market, and with more than 40% of its customers leasing their vehicles, the loss of these incentives could discourage potential buyers. The Detroit Big Three General Motors, GM, Ford, and Stellantis could also experience a decline in EV sales. However, analysts believe they may be better positioned to weather the storm due to the diversity of their vehicle portfolios. Piper Sandler notes that these legacy automakers could offset losses in EV sales with higher margins from their traditional gas-powered vehicles, which remain popular among U.S. consumers. Despite these projections, not all analysts are pessimistic about the long-term outlook for EV adoption in the U.S. Morgan Stanley's Adam Jonas believes that while eliminating the tax credits could create short-term headwinds and higher upfront costs, the EV market will continue to grow over time. Factors such as technological advancements, declining battery costs, and increasing public awareness of environmental issues are expected to sustain the EV transition even without the federal tax incentives. It's also worth noting that Trump cannot unilaterally cancel the IRA tax credits. Any changes to the legislation would require congressional approval, which could pose a significant hurdle depending on the political composition of Congress. This means the timeline and feasibility of such a policy shift remain uncertain. For automakers, the potential loss of the IRA tax credits could prompt a strategic reassessment of their pricing, production, and marketing strategies in the U.S. market. EV are already more expensive than traditional gas-powered cars, and the removal of federal incentives could widen this price gap, making it harder for consumers to justify the switch to electric vehicles. Furthermore, the potential repeal of tax credits could disrupt supply chains and deter investments in EV infrastructure, such as charging stations, which are critical to supporting widespread adoption. Such developments could delay the U.S. achieving its clean energy and emissions reduction targets, which rely heavily on the growth of the EV sector. The potential impact of Trump's proposal extends beyond the U.S. market. The U.S. is one of the largest EV markets globally, and any significant policy changes could have ripple effects on the global EV industry. For example, international automakers that depend on the U.S. as a key market might rethink their expansion plans or redirect resources to regions with more supportive policies. In addition to market implications, the repeal of the IRA tax credits could have social and environmental consequences. EV adoption is a crucial component of efforts to combat climate change and reduce greenhouse gas emissions. A slowdown in EV adoption in the U.S. could hinder global progress toward these goals, particularly given the country's significant contribution to global emissions. While automakers and policymakers grapple with the uncertainty surrounding the future of EV incentives, consumers may also face tough decisions. Without the tax credits, the affordability of EV will likely become a central concern for many prospective buyers. This could push some consumers to delay their transition to electric vehicles or opt for less expensive gas-powered alternatives. In conclusion, the potential elimination of federal EV tax credits poses a significant challenge for the U.S. EV market and could have far-reaching implications for automakers, consumers, and the environment. While some analysts remain optimistic about the long-term prospects for EV adoption, the near-term impact could include reduced demand, higher costs, and slower progress toward sustainability goals. However, with congressional approval required for any changes to the Inflation Reduction Act, the fate of these tax credits and the future of the U.S. EV market remains uncertain. Back to you, Brad.